Do you know how to profit from inflation while everyone else is losing? Most people talk about national debt but couldn't tell you how money really works. Who prints it or why it matters? Sounds boring, right? Well, hold on to your wallet because this is where it gets interesting. When you understand how money works, you stop just working for it and start making it work for you. Instead of spending your life saving while others print wealth in seconds, take a deep breath, slow down, and start learning how to take control. Let's dive into it. Every hour of every day, a government facility in Washington, District Columbia is cranking out paper like it's on a never-ending printing press. Machines runs 24/7, pumping over $500 million into the US economy daily. But hold up, that's just the tip of the iceberg. Most of this money is actually digital, growing by over $4 billion every single day. Now, where does all this money even come from? Spoiler alert. Before it lands in your bank account, it changes hands more times than a game of hot potato. It's passed around between governments, businesses, and individuals, all after being typed into existence on a computer. Yes, typed. Your money is just some digits on a screen. Fancy, right? Now, to really get how money works, how it drives the economy, inflates prices, and creates debt, we need to rewind to a time before money even existed. Picture this. Thousands of years ago, if a farmer needed a tool, he would go to the tool maker. But here's the kicker. He didn't have anything to give up front. So they agreed that the farmer owed him something in the future. Trust made that promise acceptable. So imagine that. 2 weeks later, the farmer shows up with food to settle the debt. Hope the toolmaker liked his veggies. To make life easier, people started using stuff like cattle, grain, and salt as currency. These were things everyone needed, and most importantly, they were scarce. The farmer could now pay for that shiny new tool with grain, making the exchange quicker and fairer. But wait, holding cattle and sacks of grain was a bit bulky, right? So people switched to metal coins, gold and silver, small, durable, and universally valuable. This game changer opened up global trade. People from China to Europe could now exchange goods and services. But carrying all that gold around was risky, so enter the next evolution of money. In 17th century London, goldsmiths started taking in people's gold coins for safekeeping. For a small fee, they would give customers a piece of paper, a promise note. This little note allowed people to claim their gold back anytime. The catch? The note itself had no real value. But here's the fun part. This paper became as good as gold. Who knew a scrap of paper could have so much power? Soon, people were exchanging those notes just like they were actual gold. The goldsmiths realized something interesting. Most people weren't coming back for their gold, so they thought, why not loan out some fake promise notes to customers? Instant money. No gold involved, just a note with a promise. And of course, that had to be paid back with interest, which made the goldsmiths a small profit. But here is the twist. When the goldsmith loaned out 100 coins, they didn't actually lose 100 coins. Nope. They just wrote a note saying it was worth 100 coins and voila, instant money. This fake money could be spent anywhere. Eventually, the customer would pay back the loan plus interest, making the goldsmith 105 coins richer. Now here's where it gets fun. From that single loan, the total money in existence increased by 100 coins. But hold up. No new coins were even created. More money was in people's hands than actually existed. Sounds a bit like what's going on today, right? You have gotta wonder, where is all this fake money coming from now? Let me know your thoughts in the comments below. If we replace the goldsmiths with banks and the promise notes with digital money, we have today's system of money. Nowadays, almost everything is bought and sold digitally. But did you know that data brokers buy and sell your personal data? These could be used against you for things like scams, identity theft, stalking, and harassment. On top of that, when marketing agencies get a hold of your data, they start sending you a never-ending supply of spam. When 17th century goldsmiths began issuing fake money, it transformed the economy. Before, money simply circulated in a cycle with no new money entering the system. But this had a flaw: uneven distribution. Imagine 4 people sharing $100. If one pays another for food, the money moves, but the supply becomes uneven. As money circulates, productivity grows, but eventually fewer people can participate, slowing trade. The system only works if everyone pays the same amount at the same time. Impossible in reality. Adding new money speeds up the economy, fueling business growth, production, and progress. A constant flow of money is essential. But how is it created? Banks aren't just storage vaults. When you deposit money, they owe you. Your account balance is a promise, not physical cash. When banks lend money, they create it digitally. They don't lose wealth. They type new money into existence. When you repay the loan, the money is cancelled, and the banks keeps the interest. That loan might buy a car, paying dealerships employees who then spend it, creating more transactions and driving productivity. However, creating money without matching productivity causes inflation. If goods decrease while money increases, prices rise. Banks now have a near total freedom to create money. If they run low, they simply request more from the central bank, a system that's both powerful and precarious. To create new money, the government creates a bond, which is essentially a loan that provides a steady income. Banks, corporations, and foreign countries buy these bonds from the US government, and this influx of money goes toward the government's budget. The government uses this money to pay companies and people, and it eventually makes its way back to the banks. The problem is, the US government almost always spends more money than it makes. So it is constantly in debt to those that buy bonds. In order to pay for that debt, it uses the taxpayers' money. So last year, the government spent almost $7 trillion, but your tax money wasn't enough to pay for this. And so the government had to create new bonds to receive more money, putting it further in debt, and the cycle continues. So what can you do with this knowledge? Start by leveraging low-interest loans to invest in appreciating assets. For example, if you can secure a mortgage or business loan at a 4% interest rate, invest in real estate or a venture likely to yield 8% or more annually. Use tools like index fund, for example S&P 500 ETFs, for steady long-term growth, or explore peer-to-peer lending platforms for higher returns. If you are risk-averse, consider high-yield savings accounts or government bonds, which, while not outpacing inflation dramatically, still protect your money better than traditional saving accounts. Next, diversify your income streams in ways that align with your skills. If you're tech-savvy, learn coding or digital marketing and use freelance platforms. If you have a hobby like photography or writing, monetize it through stock photo sites or self-publishing on Amazon. For passive income, consider dividend-paying stocks or rental properties. The key is to create multiple revenue streams so you're not solely dependent on a paycheck. By the way, how many different ways are you earning money right now? Time to level up. Finally, protect your financial future by staying informed. Follow central bank announcements and economic trends to anticipate inflation or interest rate changes. Use budgeting apps like YNAB or Mint to track spending and identify areas to save. As crazy as it sounds, this system of adding more money through debt is how most of the world operates. It isn't necessarily a bad system. It's just not running anywhere near maximum efficiency. If banks created money for more productive things like businesses, education, and infrastructure, all of this money going into the system could give us higher returns in the long run. If this hit home, don't forget to like the video. Every little bit helps, and I promise it will keep bringing value your way. Here's how you can use this system to your advantage. Debt, when used strategically, can be a powerful tool. For example, in real estate, taking on a mortgage allows you to leverage a small down payment to control a much larger asset. If the property appreciates, your return on investment is amplified. Similarly, debt can be used to optimize taxes. Businesses often take loans to deduct interest payments, reducing taxable income. Even individuals can use low-interest loans to invest in tax-advantaged accounts or income-generating assets, effectively turning debt into a wealth-building tool. The key is to borrow wisely, ensuring the returns or benefits outweigh the costs of the debt. So guys, thank you very much for watching, and I will see you in the next video.